Hello everyone. This is Sanchit Malik. I'm co-founder of Townscript. So I usually write my blogs on startup02.com. I had written a blog in November 2014 about how startup funding works. I got a great response from startup community and everyone liked the blog. But I found that people still had a few doubts and they wanted me to clear their doubts. So I thought I'll make a video blog and try to explain you through video. I'm going to explain you now how startup funding works. So to start with, I'll take an example of two friends, A and B. They plan to start an e-commerce company. Okay, they have got a great idea in e-commerce industry, and they feel that this idea is going to be very huge, and they have got great skills. One friend has great technical skills, and second friend has great business skills, so they think that they can make it really big. So after that, what they do is they decide to make a private limited company, and they decide to issue around 1 million shares in the company. Okay, whenever you are making a private limited company, you have to have shares in the company allocated to different people who are the owners of the company. Here, taking as an example, both friends A and B decide to have 1 million shares in the company, and they decide to split it with 50% each. It's always recommended to have 50-50% share split when you are at idea stage. Friend A has 500,000 shares and friend B has 500,000 shares. Before going to the next step, I just wanted to clear it out with you. Like, I'm going to explain it with a balance sheet example. Okay, how the company's valuation work are asset is always equals to equity plus liability. Okay, if you're not planning to have something like loan, or if you're not planning to take some money from any of your friend, then your liability will be equals to zero. Okay, in that case asset will be equal to equity. So this is what I am assuming, that friend A and B decide to not have any loan in the company, and so in this case asset is equals to equity, as you can see in the picture. Idea plus skills, so whatever current value you have before any funding, it's on the basis of idea and skill, because you haven't developed anything as of now, no revenue, no product, anything. Till now we have understood that A and B formed a company, and they split their shares equally with 50% of the whole valuation of the company, that is like considered to 50% of assets. Okay, so now if you see A and B, what they do is like they decide to talk to some angel investors. Okay, so why do they decide? First of all, let's discuss about that. First and foremost important thing is their platform is e-commerce platform. It's very scalable, it can be used anywhere in their country. Okay, so anyone can go on their website and order, so the market size is very huge. Second thing is, because the people are now coming online day by day, so their market is definitely going to increase. Third thing is they have a very good team. A and B both have complementary skills. So considering these 3 to 4 points, they think that they need an early investment in the company and they should talk to a good angel investor. So secondly, let's discuss about who is an angel investor. Angel investor is somebody who is an individual, okay, and he has made something big in his life. For example, anybody who started his business and had an exit, so he can be the investor of your company. So what they do is they go to an angel investor. Now they have a negotiation with angel investor, and they talk to the angel investor and they tell them that this is a $1 billion market, and this market is growing every year around 10 to 15% year on year, and we are a good team. We both have complementary skills and we come up with a great experience which can definitely be helpful in making this company big. So on those basis, we project that we need 20 lakhs for 6 months to develop the product and to hire initial members in the team. Okay, on that basis they talk to the angel investor and then they try to convince him to invest 20 lakh in the company. So angel investor says, okay, I'll invest 20 lakhs in your company, okay, but I want around 15% shares in the company. But these people try to negotiate with the angel investor and they come to a conclusion that he will get 10% shares in the company. Usually around 5 to 15% shares are given on angel investment. 10% is a very good norm, but it totally depends from situation to situation, depending on your market size, how market is growing, what kind of team you are. So on all those factors, it totally depends like how much dilution you should do. Ideally, like it shouldn't be more than 10 to 15% in case of angel investment. So they talk to the angel investor, and all of the people come to a conclusion that the angel investor, I'll consider him as C, will get 10% of shares in the company on the basis of 20 lakhs. So now the question comes, what will be the valuation of the company at this point when the angel investor comes in the picture? Assuming that the company's valuation is X, the person invests 20 lakhs and he gets 10% shares. 10% of X is equals to 20 lakhs. Right? You got it, right? So 10% of X is 20 lakh rupees, Indian INR, and X is, I'm assuming that everybody is good with simple maths. This 20 lakhs is 200 lakhs of rupees. So this is your company's valuation. X is 200 lakhs, which is nothing but 2 crore rupees. So at this point of time, after the angel investor comes in the picture, the company's valuation is 2 crore rupees. Now the question which must be coming in your mind is, how did this valuation gets decided? There are a lot of factors on the basis of market, on the basis of team, on the basis of how fast is the market going, on the basis of at what stage the company is in. There's also a very norm way calculate the valuation is discounted cash flow. You should Google search it. Now let's see how much worth of shares A and B have now. Earlier A and B owned 100% of the company. Now they own 90% of the company because 10% of the shares have been given to the angel investor. So if they own total 90% and they own 50% of 90%, that means they now own 45%. I hope you're getting it right. It's very simple maths, right? Please note that this is not loan, okay? The A and B are not liable, or the company is not liable to give that money back to the investor. It's an investment and it's a risk which has been taken by the angel investor. If the company goes down, he might end up losing the money, but he believes in A and B. Like, we are sure that A and B are going to give their 100% efforts to grow the company. So that's how it works. It's very different from loan. Sometimes people get confused and think that they are supposed to give that money back. So how does angel investor make money? So whenever there is a next round of investment, or whenever there is an acquisition, or whenever a company goes public, so first investors get an exit in the company, and after that, based on the deal, the founders get exit in the company. I hope you are getting till this point. So let's come to the stage 3. The investor C came in the picture. Okay, he got 10% shares in the company, and rest 90% of shares were owned by A and B. So after that, they built a strong product. Then they worked really hard and built a great team. And apart from this, they started getting early customers, also started generating good revenue, which was growing. So they built a good product, great team, got early customers, good revenue growing, and their business is also growing. So now they go to venture capitalists. So venture capitalists are those people who raise money from others and they invest in different companies. Okay, so that is not their own money, like as in case of angel investors. So they raise funds every, like once in 5 to 10 years. They raise a fund of venture capital. Okay, so they invest in early startups like the company of A and B. They're just at a valuation of 2 crore. They invest from ranging from around $1 million to $15 million. So after that, after this stage of venture capital, then the next stage comes is private equity, or like other Series A, Series B type of investors. Right. So the how the process works. So this is like, you can consider the next stage. That is the ultimate stage. After this, the same process keeps on going on. Okay. let's assume A and B, they approach a venture capital, and the venture capital gets really impressed by their work, and then they decide to invest 5 crore rupees at a valuation of 20 crore rupees. So they will value company at 20 crore. So that's they negotiated and all, everything happened, and then the final decision is like venture capital is going to invest 5 crore at a valuation of 20 crore. Let's assume venture capital is D, okay, and they are investing 5 crore and getting 20 at a valuation of 20 crore. That means the post money shares that they will get will be 25%. Okay, now A, B, and C will own 75% shares in the company. So A and B were the founders, C was the angel investor, D is uh, the new venture capital investors. So generally what happens is like when there are too many angel investors, they give exit also to few investors. Depends on the situation. Assuming the angel investor wants to stay here for a long time because he thinks that the company is going to be big, so he decides not to exit. Now the venture capital owns 25% shares of the company. Let me tell you how much A and B will own. They owned 45% shares earlier, right? So 45% of 75% shares are being owned by A. I'll tell you how. So if you remember, 90% were owned by A plus B after raising investment. Now out of that, 25% shares is of total shares are owned by D. So they now definitely together own 90% of 75%. I hope you're getting it. It's pretty easy. If you have any doubt, you can ask me in comments. As an individual, A will now own 45% of 75%, which comes out to be 33.75. So 33.75 plus 33.75 is 67.5. 25% is owned by the VC. Rest 7.5% is owned by the angel investor. 33. If you see 67.5% of 20 crore rupees, which is the valuation of the company, is 13.5 cr. So together A and B now own shares total worth of 13.5 cr, but their percentage is 67.5. So if you remember, in earlier round they owned 90% of the shares of the company, and they owned their shares worth value was 1.8 cr together. Okay, now they own 67.5% of the company, and their value is around 13.5 cr, which is like around 10 times of the previous value of their shares. So the point there is their value keeps on increasing with time, like when in with the next rounds, but the the percentage of the shares will keep on increasing with time. Okay, so I hope you get it. Mr. Angel Investor C had invested 20 lakhs, and now he owns around 1.5 cr worth of shares. Okay, so this is pretty cool. This is pretty exciting as well for the angel investor because he had invested around 20 lakhs, and now his shares are worth of 1.5 cr. Okay, which is a